Hey everybody, thanks for joining me. I am going to talk about one of my favorite stock opportunities in the market right now. It's one that I've been buying heavily over the past couple months, and it's already one of my larger positions. Before we dive in, please take a minute and click subscribe to my channel. Check out the link you see on your screen for a message from our sponsor, The Motley Fool. It's the top 10 stocks to buy right now, and it's the best way to support this work I'm doing on YouTube. Again, that is fool.com/Frankel. So the stock I want to talk about is a company called Kinsale Capital. Ticker symbol is KNSL. Now, they're an insurance company, but they do things a little differently. They don't they're not a general insurance provider. In other words, you or I couldn't just call them up and get homeowners insurance or life insurance or anything like that. They are a specialty insurer. They operate in what is known as the excess and surplus lines in the insurance business. And basically, this refers to anything that falls outside the realm of typical insurers. Um, Generally, it refers to things that where the risks are either hard to quantify or it's a high risk business or something like that that needs liability insurance. For example, if you wanted to start a demolitions business, that's something that's inherently high risk and a lot of insurers wouldn't want to touch. If you wanted to open a marijuana dispensary, for example, that's a new industry. The risks of that are really, really hard to quantify. Those are the types of situations where you would go to a company like Kinsale, a specialty insurer. And there's a few unique things about it. Let me share my screen real quick. So, the first thing I wanted to mention is that Kinsale is the only pure play specialty insurer in the entire stock market. Now, you can see on that list to the left of the screen that a lot of major players compete in this market. You got Berkshire Hathaway, you got Markel, you have AIG. There are some really big players there, but Kinsale's the only one that is focused exclusively on specialty insurance. And even beyond that, they focus on smaller accounts where there's less competition, more room for profit, things like that. So speaking of profit, why why specialty insurance? Why are we even paying attention to this? So specialty insurance is hard to do, admittedly. That's why it exists. There are risks that you can't quantify, high risk businesses, special situations, things like that. It's hard to do, but if you can do it well, it can be very profitable. So the the slide you see on the screen right now, look to the bottom two lines. This is the combined ratio, or I'm sorry, this is the net loss ratio of regular property casualty insurers versus the E&S insurers. Now, a loss ratio is, in simple terms, the money that an insurance company takes in as premiums, what percentage of that they are using to pay out for claims. You can see over the past 20 years, the excess and surplus lines or specialty insurance had profit margins that were over 400 basis points better than typical property casualty insurers. Now, Kinsale is not the average specialty insurer, and we'll get to that in a little while. I'm going to stop my share real quick. Now, Kinsale, like most insurance companies, makes money in two key ways. They make their money from underwriting income. In other words, taking in more from premiums than they're paying out and using to support their business. And on the other hand, they make investment income like most insurers do. Um, the money that they've taken in but haven't yet paid out, they invest in mostly fixed income instruments, but we'll get to that in just a little while. Um, so those two components actually combined for a lot of profitability in this case. Just to kind of show you what their investment portfolio has in it. So you can see this chart on the right-hand side is the asset allocation in the investment portfolio, mostly fixed income. Although one interesting thing to note and to keep an eye on is that the portion that are equities, meaning stocks and ETFs, have increased significantly over the past year or so. So maybe they're getting a little more comfortable with their reserves and they're willing to take on some stocks and, kind of like a Berkshire Hathaway does. I don't want to call them an early Berkshire Hathaway or any of that because that term gets thrown around a lot. But it is worth watching the equity concentration in the portfolio. But generally, you see U.S. Treasuries, municipals, corporate bonds, mortgage-backed securities, things of that nature is what makes up that whole investment portfolio. So Kinsale's management team is a pretty big part of the thesis here. Um, the company was co-founded by Mike Kehoe in 2009. He was formerly the CEO of James River Insurance, which is Kinsale's biggest competitor in terms of its concentration in specialty insurance, and essentially set out to create a company that focuses exclusively on specialty insurance. He's been in the CEO spot for the 15 years that Kinsale has existed, has done a fantastic job of beating the market over time. We'll get to the actual performance in a little while, but he surrounded himself with a pretty impressive team. Brian Haney was kind of his right hand at James River and followed him over there. Has been there for 15 years, works as COO right now, and you can see a lot of experience between this team. Um, Mike Kehoe and Brian Haney are a big part of this investment thesis. They are. It's tough to imagine anyone who is more qualified to run a specialty insurer than the two of them, especially one that focuses on small accounts and intends on being a pure play in the space. Um, so you can see kind of where the company stands right now. And so I mentioned performance a second ago, and I mean, there's really no other way to say it. The performance has been fantastic so far. The company didn't go public till 2016, and immediately had a great year. It doubled the first year it was public, and it has beaten the S&P 500 in all but 1 year since its IPO. That was 2021, when the S&P was kind of in rapid growth mode, led by a bunch of tech companies. But even the year it underperformed, Kinsale still delivered a 19% percentage gain for investors. Overall, since 2016, that isn't that long ago. That's 8 years ago. Kinsale has delivered a gain of more than 2,000% for investors as of the end of the first quarter, and that's compared to 151% for the S&P. It's been a fantastic performer. So you might be asking, why now? So the reasons I'm so interested in this company right now, I mean, I've been an investor for a few years now, but right now it is down 29% from the highs. There's some fear from its first quarter earnings numbers that growth might be slowing down a little bit, and it is, but this is a profitable company growing at a rapid pace, with a great leadership team and a very big market possibility. You can see right here that on the left, you see a kind of landscape of the specialty insurance market. It's a very fragmented space. Only one company has over a 10% market share. That's Lloyd's. Um, the other companies with big shares tend to focus on larger accounts. Kinsale has 1.1% of the market right now. So 50% of the market is controlled by companies outside of the top 10. A lot of potential to um, gain market share over time. Its tech gives it a pretty big advantage to its peers in terms of cost. So Kinsale can usually undercut its competitors on cost. And here you can see, I mentioned earlier, this is really a why now. I think kind of they're prime for growing their market share rapidly in the years to come. And one of the big things that is important to notice, if you see right here, the yellow bar is Kinsale. The bottom numbers on these bar graphs are the loss ratio, meaning the percentage that we're paying out to cover claims of the premiums that are coming in. We mentioned that earlier. The top number is what's called the expense ratio. That's the percentage of the money coming in that is being used to fund the business, other than paying out claims. Paying for your offices, paying for salaries, things of that nature. Um, if you notice, Kinsale's is the lowest on the list by a significant amount, and a big reason is they have proprietary technology that makes their underwriting process a little bit more efficient than the rest of these companies, and allows them to spend less money running the business. So not only is their loss ratio one of the lowest, it's not the lowest on the list, but when you combine them, this is known as a combined ratio in insurance. Kinsale's, this is the 2021 to 2023 average, so a 3-year period. This is by far the lowest number on the list. This means, so subtract that from 100, this means Kinsale has a 23% margin almost before you even think about investment income, which is where most insurers make their money. You can see a lot of these companies, 89%, 93%, 97%, they almost break even on underwriting and make their money off of investments. Kinsale is the opposite way around. Investments are just kind of a cherry on top in a way. Kinsale makes most of its money from underwriting very, very profitably. Big, big cost advantage over rivals. And it's one that I think will allow it to continue to grow at a very rapid pace for years to come. And now is a rare time when it's at a roughly 30% drawdown from its all-time high. And it's one that I am taking a very close look at to add even more. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.